Chart patterns are powerful tools, but trading them the moment they appear often leads directly into a trap. This is where many retail traders lose their capital by reacting to the shape rather than the price action. To trade these effectively, you need to master 5 high-accuracy patterns and learn to distinguish between a trend that is reversing and one that is simply pausing. We are using an entry strategy designed to wait out institutional fakeouts, ensuring you only enter when the market confirms its new direction. Learning to identify these visual boundaries shifts your approach from guessing based on market noise to executing a rules-based system. Markets eventually lose momentum. When the prevailing trend exhausts itself, reversal patterns form at the extreme tops or bottoms of the price range. In an uptrend, bearish reversals, like the head and shoulders, form 3 peaks, the middle sitting highest. Conversely, a downtrend space forms bullish reversals.
Patterns like pedonal bottom create a W shape. Once identified, connect the critical points to draw a neckline. This neckline marks the specific level where the previous trend structure has shifted. Not every pause in price movement is a reversal. Bullish and bearish flag patterns represent healthy, temporary corrections within a strong move. A flag pattern consists of 2 parts: the initial steep price surge, known as the pole, followed by a tight, choppy channel moving in the opposite direction, the flag. To define the pattern, draw 2 parallel trend lines connecting the highs and lows of that choppy channel. Boxing in the price action tells you to do nothing until the boundary is broken, preventing you from exiting a trade during a standard correction. The mistake that destroys most accounts is entering the trade the second the price crosses a neckline or trendline.
This leads to a fakeout trap, where the price breaks a boundary far enough to trigger orders before jerking back in the opposite direction. To avoid this, we apply the retest rule. This is the primary defense against institutional volatility. In a valid retest, the price breaks the boundary, loops back to touch the line from the outside, and is clearly rejected. We only enter when we see a confirmation candle, like a bearish engulfing or bullish hammer, exactly at that retest point. Waiting for this confirmation transfers the statistical advantage from the market makers to your own execution. Every entry signal requires predefined risk and reward parameters to be valid. Place your stop loss just beyond the extreme wick of the candle that confirmed your entry. For a flag pattern, measure the height of the original pole. This distance is then projected outward from the breakout to set your take-profit target. This same logic applies to the head and shoulders. Measure the distance between the head and the neckline to find your target. Using these geometric measurements ensures a consistent risk-to-reward ratio and removes guesswork from the exit. Clean animations rarely match the messy reality of live market data. On a real chart, a head and shoulders pattern will almost always have asymmetrical shoulders. As long as the right shoulder does not drastically exceed the height of the left, the structure remains valid. Your necklines don't have to be perfectly horizontal. They should be drawn on a slant if it connects the actual price touches on the chart. Focusing on structural anchor points rather than visual symmetry prevents indecision when trading in real time. Spotting the pattern, drawing the boundary, waiting for the retest, and setting targets. These 4 steps form your complete strategy. Your next step is to use a demo trading account to practice identifying these exact boundaries without risking your own capital. Do not trade the pattern itself. Trade the retest. Profitability and price action comes from the discipline of following these rules, regardless of what the pattern looks like on the surface.